Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Farzin Azarm, Head of International Sales and Trading at Mizuho Americas, as well as Jimmy Lee, Founder and CEO of Wealth Consulting Group. They join me to discuss the shift from earnings to macroeconomic factors and why we could see more volatility come back to the markets. Gentlemen, it's great to have you both with us. Welcome to Trade Talks. And Farz, we'll kick it off with you. We certainly are seeing some volatility back in the markets this afternoon. Certainly the VIX and S&P 500 both trading higher heading into the week, and now we're starting to see some of these themes play out. What are your thoughts in terms of where we are within the macro environment?
Well, Jill, good seeing you. Jim, good seeing you. The issues that I have in this market on the macro side is very hard to be able to trust anybody that comes on TV and telling us that everything, macro-wise is easing and we're gonna, get closer and closer to soft landing. Because just today, if you look at the S&P Global Service PMIs that came out, even though that average price are rising at slowest rates that we've seen in about 4 years, but look at the inflation. It picked up again in the goods and services in February, and this is the highest that we've seen since June of last year. So, I think what the market is really ignoring is this narrative and this fear and risk of that we're going to be higher for longer, and we're completely brushing that aside. And I have to tell you that the 2 year and the 10 year is definitely telling us something, even though they've eased this a little bit today, which has given, I come from a background of equities trading, so it's given a lot of people a little bit of a head fake as we've seen rates go back to 430 in the 10 year and the market actually going higher. And today we've eased and the market's going lower. So people are not making a whole lot of what the bond market is telling us, but the one thing that is really screaming and what the Fed members are telling us that, we're not going to be seeing, any kind of a immediate cut on the rates. Apollo came a couple of days ago to the extreme of saying that there's not going to be any cuts this year. And I don't think that's that far-fetched. Just today, I was looking right before I walked over here, the national average price of gasoline has jumped back to 337 across the country. This is the highest tally we've seen since November of last year. So now you have the summer gasoline jump that's going to come around the corner. It's going to be very slowly trending higher, but that's not going to take the foot off the gas of higher inflation as we go forward. So I've got my concerns, but I got other concerns about the market and the level of concentration as well. So
yeah, and we'll get into that in a moment here. But Jimmy,
yep.
you had noted that now that we're coming out of earnings season, we'll be in that vacuum of news. Basically, it's going to revert back to everything on macroeconomic factors, what the Fed's doing, inflation, rate policy, and so forth. So, the market's going to be focused on that again. And if you think about it, it was pricing in 6 cuts for 2024. I think we'll be lucky if we get 3. However, we continue to hit new highs, up until the movement that we're seeing today. But the shift back to what's happening with the macro, I think, could impact the headlines a bit here.
I agree with what you're saying and what Farza said earlier. I think there's a lot of concern about stickier inflation. I'm a little bit more optimistic about hopefully what might happen towards the end of the year. I think that inflation by the end of the year is going to look a lot better, though. And from now until then, though, we could see a lot of volatility, especially with rates. I think we could see the 10-year range, being wider and could create a lot of volatility with fixed income and assets that are rate sensitive. That being said, I think we've had most of the investment houses raise expectations on expected earnings for this year. And we're starting to see some of the people that I follow that are bears, some very respected money managers and analysts at different shops I won't mention, but they're starting to talk about a different tune, closer to a soft landing. But yes, there's still a lot of concerns out there. We were just talking at the break about what real inflation looks like in cities like New York and other places, and I think part of that will hopefully get better as rates ease. But I don't really see anything currently, though, that are issues such as commercial office. That's a big problem, but it's not big enough to be systemic issue, I don't think, to take the entire economy down. So I'm still hopeful and optimistic about 2024.
Right. Well, I think, and Farz, you had alluded to this before, part of the issue, if you're thinking about risks that are in the market, and of course, the market's always going to climb a wall of worry, is the concentration in terms of where we're seeing outperformance. Are you starting to see breadth improve, and are there opportunities outside of tech?
No, there's definitely a narrative that's going around that the breadth is improving. And I think to me, that's kind of nonsense. We are seeing Russell having a little bit of a bounce as we're going into the first 2 months of this year, and we've seen the equal weighted indices kind of catching up a little bit. But end of the day, it's about Nvidia, and it's all about Nvidia. I mean, and there's no other two ways around it. I was looking at the markets yesterday with some of the bigger cap names such as Apple, Google, Tesla being down, and these are one of the top 6 names, 7 names on S&P, and we still looked at a market that at one point Nasdaq was up yesterday. So, and that's all have to do with the way Nvidia's price performance has been, and that to me is becoming a concern. And I think if you guys have ever listened to Mike Green and even the latest Ackman's comments that just came out about passive investments, that's a big part of what we're seeing in the narrative in the market and how for every dollar that's going in. So I think the perfect example of the way this passive investments works is that if you put $1,000 into the market, for every $1,000 that you're putting in, approximately probably close to $200 of it is going into Microsoft, and about 25 cents of it are going to United Air, right? And the liquidity in these names are practically the same. And all it does is passive investment is kind of goosing up and giving more, obviously gaining the big market cap shares as this money goes into this, let's say the Vanguard S&P fund, right? And this is a narrative that keeps, self-fulfilling as it goes along. I was looking at it today, and S&P's gained about 360 points year to date. 105 points of it alone is Nvidia. So it's about 28% of the gain of this year. And you add Meta, Amazon, and then also Meta, Amazon, and Microsoft to it, and these 4 names alone are 56% of the S&P gain. We never even saw this back in the 2000 bubble. So I am very concerned about the level of concentration, even though we are seeing some broadening out. But again, I think everybody used to say if once Apple goes, the market goes. My fear is if Nvidia goes, the market goes. And right now, there is no question about their earnings was just it's nothing we've ever seen in our lifetime. But at the same time, when you look at it on a retrospect, they are priced to perfection. And this growth, we have to really question it if they're going to continue growing the way they are as we go forward. And I think that's a very big risk to the market right now.
Right. And to your point, the momentum's going to continue until it doesn't anymore. So, Jimmy, my question to you is, if we're looking outside of tech, there are thousands of other companies to be traded or invested in. Where are you looking for value? Do you think it's time to start nibbling here at other names outside of the Mag 7?
We've been saying that until we get a rate cut, that you're going to continue to see the big cap tech names continue to do well, large cap growth. And I think we're going to see that. And as we get closer to when the Fed signals a rate cut, I think you're going to see more broadening into, small cap stocks. And I think this whole, flow of money going into AI, while I'm naturally a value type investor, and it's very tough to see value in some of these areas, but I think we're so early in the game of AI that there's going to be so much money flowing to companies there. What we may see is some smaller tech companies getting some traction with AI, not just the big names. And so I think maybe there'll be money flowing into some other areas, but I would want to be ahead of what we're going to see later on this year. And so we're longer term investors. We work with clients with their retirement monies, and financial independence is what we talk about. So we're not trying to market time and focusing on the long term. From a trading perspective, though, I think you need to get ahead of rates coming down. So a lot of investors are very short on duration still because of the rate volatility. We're very confident that rates will be lower at the end of the year. We think that long end of the market might move a little quicker than the short end. And so you want to get ahead of that trade. So just making sure that you've got good diversification with fixed income and you're not too short there in duration, I think is an idea. We also think that, pay attention to what's going on overseas. And you're starting to see some other areas like Japan that's been struggling for so many years do well recently. Valuations are definitely better in Europe still. But the U.S. is, on a global perspective, probably going to produce better earnings. But I think a lot of investors are still underweight, overseas equities. And so take a look at that. And I think that we could see a trend of a softer dollar and make sure that you got enough exposure there. So I think a good barbell between cyclical sectors and tech still make a lot of sense.
Yeah, it's interesting because a lot of the strategists that we have coming on the show saying something similar to what you are. Industrials, healthcare is another big sector that they're looking at, even energy, not nibbling on financials just yet, but still it's every time you look at, where the attribution is coming from, it certainly is tax. It'll be interesting to see how it plays out, especially once we start to get some of those rate cuts as it impacts, the smaller cap companies where cost of capital, they are especially sensitive to, when you look at their balance sheets relative, to what's happening with these larger companies like an Apple, like an NVIDIA. Far as outside of the US, outside of what's happening with Fed policy, what other risk factors are you paying attention to?
Again, I think it's really funny that Jim just brought up the fact that he looks at it as a value portfolio manager looking at something, and a value person that did look at the markets on a value basis. It's really funny. Like you look at somebody like a Kathy Woods of the world, right? That they're just being scrutinized all the time for selling their NVIDIA shares. But that's what value portfolio managers do. When something gets too big in the portfolio, they need to be able to scale it back to be able to balance it out, and that's not what we're seeing at the current time. What I think there's a lot of geopolitical issues that are still kind of lingering. I'm not by any means brushing that aside. I think what is happening in the Mideast, what is happening in Russia, I think this is something that's kind of been brushed aside, and I don't think that's something that we have to turn our backs on at the current moment. And I think that's another concern that I have when it comes to energy and oil as we go forward. And I think you're a pinprick away of WTI making a move towards 100 again. And as we know, that the oil market is extremely tight. The OPEC is kind of flagging that they're not going to be doing anything crazy going forward. And I think right now the fear is there. But again, my biggest concern, more than geopolitical and outside issues and outside fears, is really this level of concentration. And I think everybody's kind of piled on to this whole tech narrative. And as I said, I'm not by any means dismissing the earnings that these companies are coming out with, but we did see the same thing, because it's I think one thing that works to my detriment is being old and I've seen what happened, the build up until the 2000 bubble, of how people were kind of piling on, and the Cisco's and the JDS unit phases of the world and the Nortels of the world, and there were real companies back then. But the level of concentration that we're seeing now, it's kind of nothing that we've seen ever in the past. Like, and back in 1995, the top 10 U.S. stocks were 6% of total U.S. GDP. We're right now close to 50% of the U.S. GDP and market cap. So this is the level of concentration that I'm talking about. And to me, that is the biggest concern that I have. Then you take a step back, Jill, and you look at the way CTAs are positioned, PBs, overall books, this is the gross leverage and net leverage are now 99 percentile. The exposure into semis is close to 100 percentile, the latest data that I saw. So, and now we're seeing the indices that, such as the semi-SOX index and SMHs, are trading massive premiums to the 200-day moving averages. As I said, I don't believe, and I think a lot of the bears come in and they say there's a crash coming. I don't think we're necessarily going to see a crash. I think we may see just a grind lower and lower and lower and lower, and there's going to be a big switch. And as Jim was saying, maybe going into value. As I said, I don't think, maybe banks are not the place to put your money in at this point, just because we saw all these write-downs that we saw after the NYCB issue. But it could go to energy, it could go to utilities. We're seeing some money definitely going into industrials. That was one of the biggest themes last week when we saw in the flow of funds. Industrials were most bought by the hedge fund community last week, and they're definitely adding to it.
Yeah, and that's a great point that you make. And Jimmy, it's not just about buying these stocks and selling them when they continue to hit all-time highs. I mean, you tend to hear that in the media, great buy, great sell. But at the end of the day, you still have to think about portfolio mechanics, right? And where you're benched to. And there's more to it than just, riding the top 7 stocks. There are other mandates within portfolios that need to be satisfied. And I think, it is prudent and a good thing if we see volatility come back into the market so that we can find the next opportunity. It's unsustainable to think, and I know we have been conditioned with so much liquidity in the system to think that it's just going to go to the top of the chart. Indefinitely over time. Yes, there's averages, but I think some vol coming back in the market and identifying these new opportunities is a healthy thing. This reset could be something that investors are looking for.
And I completely agree with that. And I think the concentration of, the few companies that are really leading the market and, such a large percentage of a lot of people's portfolios, we've been talking to our advisors to make sure they're talking to their clients about it's okay to underperform the S&P 500 last year, because the only way that you would not have been able to do that is to be very overweight a few names, right? And so diversification, we think, is really important. Yes, that if those companies come down and if NVIDIA has a bad miss and it takes an entire group of companies down in the market in general, you don't want to be too allocated in those areas. Even though we're bullish on AI, I would say that one thing I would add on to the differences from the dot-com bubble and now is that the companies that people are putting money into have massive, revenue and earnings, and they're huge companies, right? Moats, and have great business models. But the other thing is, this is a bull market since the low of October 22 that a lot of investors have missed, according to some research that our chief investment officer put together using data from ICI. Just in ETFs and mutual funds, I think from the lows of October 22 through January of this year, I think 230 billion or so left equity ETFs and mutual funds. And I think Farz would probably know this data better than me. And about 150 billion flows net and inflows into bonds, but 1.4 million in change into money market funds. And that's not including deposits and checking accounts and treasuries, right? And so a lot of investors have missed this because there's been so much talk from so many credible people about a recession and a subsequent market decline. And so I think at least part of the good news is that a lot of people have not been chasing stocks, and they have not necessarily been adding so much money into those names that happened during the dot-com bubble. And so I feel like that there's an opportunity for some of that cash that's sitting on the sidelines. If we don't see a recession, which I don't think we will, and when the Fed starts to lower rates and starts to balance the issues that we have with supply, especially with shelter and housing, I think that some of that money could find its way into equities.
Mm-hmm. And Farz, final thoughts here.
I agree with Jim. I think there's a lot of money that's sitting on the sideline. There's no question about it. My last really thoughts is, back in the heydays, and this is when we were in 1999, we were watching Cisco do what it was doing. Everybody talks about the latest numbers that came out of NVIDIA being the greatest numbers that they've ever seen. And you have to go look back when Cisco reported in March of 2000 was an unbelievable number. And what happened was, this was 2 months removed when market kind of came in and NVIDIA gave off 46% of its market value. And the question that everybody asks is that what really triggered it? And sometimes you don't know what triggers it unless you just look at positioning. And to me, that's my biggest concern right now, is really positioning. And then it's a lot on the amount of liquidity that's in the market now. People are coming in, a lot of my traders, and we run a big risk book here. We now have to go look at the Reddit page again and see what the YOLO guys are talking about again, and see what's the theme of the day. And when that happens, usually I raise a big flag. And I think the other two things that I'm looking at, that we're coming to the tail end of the buyback period for the quarter. So that underlying support may be gone. Shorts are at 10-year low, so that underlying bid for the market may be gone. And then look at last week, insiders are selling. Walmart, look at the Walton family, look at Bezos, look at Jamie Dimon, look at the insiders in NVIDIA. There's a lot of guys that are selling in among the insiders. And to me, that's a little bit of a red flag also. But again, crazy can stay crazy for longer, Jill.
Yes, it certainly can. All right, gentlemen, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.